10 Common Investment Myths Debunked. When it comes to investing, many people are worried and hesitant to start. Some think they can't do it at all. Investing seems very discouraging, and you constantly have doubts. You always wonder how you can do it the right way. You always doubt yourself. The reason for this is likely the number of myths that surround investments. These myths usually start when someone makes an accurate observation, but it might only apply within a specific time period or a certain context or market. Whether these myths have any foundation or not has little to do with how widely they can be believed. Here are some of the most common misunderstandings that can change your perspective on investments. 1. Investment decisions should be made based on recent returns. Just because a fund or a stock has been successful in the past does not necessarily mean it will be successful in the future. When it comes to investing, you are never sure of anything. Successful investing means having a fluid approach to market volatility and being aware of the risks involved. If the real estate sector is in a negotiation phase, for example, you will be more inclined to invest in it. But before you do, you need to understand that every asset behaves differently, following a particular cycle. What works today might not work in the months or years to come. The current performance of a stock should not be the only reason to invest in it. 2. You have to wait until you are older to invest. You might choose to wait, but in reality, there is no right age. Many people tend to postpone things or put them off until later rather than using the time they have now. You will tell yourself that you still have plenty of time to invest in the future, but no one is sure of what awaits you. Things happen, and between now and the time you plan to retire, so many things can happen that will ruin your plans. The cost of living could change at any time. Life expectancy is unpredictable, and you could get sick or even lose your life. Taking all these factors into account, the right move would be to start investing as young as possible to ensure a better future. Investing early allows you to take advantage of reinvestment and compound interest. No matter how little you put in by investing your money, the returns you get will go a long way in meeting the effects of inflation, which means your money maintains its value when you retire. 3. You need a large sum of money to invest. When people think of investors, the image that comes to mind is that of powerful Wall Street figures with millions of dollars at their disposal. But in truth, anyone can invest. Warren Buffett, one of the most successful entrepreneurs, is believed to have started his investing career with a stock that cost $38 per share. Various investment companies have reduced minimum requirements, and some have none at all. Recently, brokers have developed apps and programs that allow you to invest starting with very little. Even spare change can be used to start. This misunderstanding has discouraged people from investing, but in essence, you don't need much. Consider investing small sums of money regularly. This will reduce the risk arising from market conditions over a certain period of time. You might try to buy fractions of a company's shares, or you might try an index fund. Starting small also means you can start early because the older you get, the more financial commitments you will have, making it difficult to set aside money for investing. 4. Avoid risks and volatility at all costs. There are always risks in investing. You can't escape them, they are inevitable. Selling your shares every time you think the market is going down as a way to try to avoid risks will not do you any good. In fact, this will only harm your long-term returns. Trying to predict the market is very difficult, and you are likely to always sell too early, which will only delay your returns. The best way to do it would be to diversify, as this minimizes losses by distributing risk. Diversification gives you the opportunity to own risky assets that have the potential to produce large returns without risking the entire portfolio. Most experts consider a portfolio more heavily weighted towards stocks riskier than a portfolio that favors bonds, but risks should be embraced and managed at the same time. As an investor, you need to find your comfort level and build your portfolios and expectations accordingly. And as the proverb says, no risk, no reward. 5. Gold is the safest bet. The thought of investing in gold is very appealing. Gold is seen as the best way to proceed when it comes to safe investments. The theory of investing in gold is based on the idea that legal currencies will lose value following the printing of money. Although there is some truth to this, the theory is imperfect. Most people invest their long-term savings in stocks and assets rather than legal currencies. Investing in gold with the idea that it never loses value is the wrong approach. Gold is subject to supply and demand pressures like any investment or financial asset, which causes price fluctuations. Obviously, gold stabilizes your stock market portfolio when added to it, and even if you don't lose money, you also don't get notable returns. The reason is that gold does not pay interest or dividends, and its intrinsic value does not increase. All in all, gold should be perceived as a barrier against volatility and inflation but not as a way to generate wealth. 6. Investing and gambling are the same thing. People assume this is probably a way to simplify their view on investment. For some, investing is just a way to make easy money, but for all those who have already done it, strategic investment is hardly considered a gamble. When you buy a share of a company, you expect it to increase in value, but it is not always so, and its value decreases. But even if this happens, the asset has the potential to increase again in the future. One of the main differences between investing and gambling is that when you buy a share of a company, you are buying a certain percentage of ownership in the company. When you look at gambling, you will notice that there is nothing of value that you get in return when you exchange money for chips at the casino and place your bet. If you have a winning bet, you get more money back, but if you lose, your money is lost completely, and there is no way you can earn from the money you gave at the beginning. 7. A 401k and Social Security are the only ways to save for retirement. Employer-based retirement plans like 401 kiloseconds are very popular but are not the only way to save for retirement. IRAs are one of these. IRAs can have a lower limit on contributions compared to 401 kiloseconds, but with these, you are able to invest up to $6,000 starting from 2020, or even $7,000 if you are 50 or older, according to the IRS. No one knows the future of Social Security, and many investors know firsthand that employer-sponsored retirement plans do not always work. Starting young and diversifying through a variety of investment vehicles is the best way to ensure your financial future. 8. The stock market is the best place to invest if you want to grow your wealth. Invest in what you know. This is one of the famous quotes by Peter Lynch. This means you should invest in sectors you know. Investing in things that give you an advantage over other investors. Many investors do not follow this advice and invest in sectors they do not understand well. They put their money in stocks that are always rising but do not know the reason. The number of investments that can be made is unlimited. Bonds, commodities, real estate, and currencies are some of the other options you have. A portfolio heavily focused on stocks might be appropriate for most investors, but if it is not something you are too interested in, focus on something else. There is nothing wrong with investing in stocks, but it is wise to invest in your strengths, not your weaknesses. You might always be creative and find something that gives you an advantage over others. It is advisable to allocate at least 20% of the portfolio in other asset classes to diversify. 9. International investments are too risky. If you look at the current markets, you might discover that U.S. investments are doing better than international ones. But before completely ruling out international investments, you should also look back between the years 2000 and 2009. You will find that a diversified portfolio of international investments significantly outperformed large-cap U.S. investments. Foreign or international markets can offer significantly lower competition and sometimes a market with greater investment opportunities, although this depends on the country or market in which you invest. Investing abroad offers investors a notable increase in investments and the potential for significant returns. Sticking to this phrase, therefore, could prevent you from making some potentially diversified international investments that could really be useful for you. 10. Professionals always beat the market. It is true that some professionals sometimes manage to beat the market, but studies show that the chances of an investment professional outperforming the market are very slim. You might get better results with a low-cost fund, but if you think about it, do you really need to beat the market? The main idea behind investing is to achieve the long-term financial goals you have set for yourself, not to compete with the market. Yes, professionals can help you achieve your financial goals and offer insightful advice and manage your money for you, but they will not always beat the market, and you should not expect this from them. Most of the active portfolio usually does not perform as well as the passive portfolio, and the reason for this is that a broker probably mismanaged your portfolio. Most of them do what is best for them and accumulate fat in their own portfolios. They tend to overtrade sometimes and increase fees that will not be in line with the goals you have set for yourself. Your best option would be to employ the expertise of a financial advisor whom you will pay their dues, and you will be certain that your investment decisions will not be exploited. This will also ensure an increase in net worth since you will be dealing with professionals. These are just some of the misunderstandings that have widely spread in the world of investments, but make sure that there is nothing definitive or absolute when it comes to investing. Knowing how to make the right decisions from calculated risks is really crucial. Investing is versatile and cannot be simply reduced to a few sets of rules. Let us know about your practical experience regarding today's topic by writing it in the comments. And do not hesitate to ask questions, we will respond to the best of our ability. Do not forget to share your opinion with us and leave a comment. If you also leave a like, it would be great. Subscribe so you don't miss the next video.